In chapters 13 and 14, we talked about ways that corporations can raise money by issuing debt or by selling shares of their own equity. Well, inversely, these same corporations, if they have free cash sitting around that they can choose to invest with, can buy into the debt or equity of other corporations as a way of making profit. Some terminology real fast before we get started. An investor is the owner of a bond or a share of stock, so the person buying the investment. The investee is the issuer of the bond or stock, so the company in this case that would be selling their debt or their equity. And that debt and equity falls underneath the blanket term called security, and that is the share of interest which represents financial value between two companies. It comes in two forms: debt securities and equity securities, which, as you can tell from the names of them, are based upon the type of financial instrument that is changing hands. So debt securities would be things like bonds and notes, and equity securities would be buying the stock of another company. Why do companies elect to invest? Well, the first bullet that we have here is the main reason. They have excess cash and sitting around doing nothing, and they can earn more money by investing in other companies than they could having that money sit around in their corporate bank account. So they'll buy bonds from other companies. They will buy shares of other companies' stock, and if they do so, they earn interest and dividends, and hopefully if they're buying stock, the price of that stock will increase as they hold on to it, and they call that gain a capital gain. So the capital gain is basically buying stock at a lower price point and selling it at a higher price point later on. Companies can also choose to invest in other companies as a business strategy. If you are a corporation and you make parts and you own, say, 10% of the stock of another corporation who buys your parts, well, they're going to be much more likely to stay in business with you because you own such a large share of the corporation. So owning equity in another company is a definite way that you can strengthen and enhance a business relationship. When companies report their investments, they need to separate them, like all assets, into short-term and long-term. And basically that is when you intend to liquidate them into cash. So a short-term investment can fall into a bunch of different categories. Marketable securities are a big one. They are securities you have which you would sell within the next year if the price was right. So if you own the stock of another company and the price of that stock went up and you knew you could sell it and turn a significant profit, and you think that you would, it should be a short-term investment. There's all sorts of things that you can buy that would fall into short-term investments. They have the term here cash equivalents, and a big one of those is a certificate of deposit from a bank or a lending institution. And essentially that is a guarantee to that institution that you will not withdraw that money for X amount of days or months. So if you buy a 6-month security of deposit from a bank, you are telling them you are guaranteeing that money is going to sit in that savings account for the next 6 months and you will not withdraw a penny of it. And for your commitment to not withdrawing that money, they're going to give you a higher rate of interest. That same concept also applies to a thing called commercial paper. That is short-term lending, no longer than 75 days, that happens from one company to another. So if a company is a little cash light and they can't, say, make payroll, they can take out a very short-term loan for 10 days from another corporation, and they call that commercial paper. The opposite of that is long-term investments, and those are investments that you intend to hold on to for longer than 1 year. And that is where the vast majority of debt and equity securities go. Bonds tend to be 5, 10, 20 years in length. The stock, if you're not committed to selling it, the first chance you have to make a profit could reasonably be on your books for the rest of time, because we've learned already that corporations have an unlimited life. So if you don't have any intention to sell it at a profit as fast as you could, you should be carrying it on your books as a long-term investment. Within these two distinctions, debt securities and equity securities, there are sub-distinctions. And for debt, they fall into 3 classes: trading debt, held to maturity debt investments, and available for sale debt investments. And basically what separates them is when you intend to liquidate that debt into cash. There's always a market out there to sell debt to somebody else for receivables that your company has. They call that factoring. The same thing with bonds. If you have a bond and you don't want to wait around for years and years and years until that maturity date comes around to receive your cash, there are companies out there that will buy that off of you for pennies on the dollar, but you get cash now. So if you're intent on selling a bond within the next period, if you think that you can turn a profit on it because that bond you have is carrying an interest rate higher than the market's going rate, you would classify that as trading debt. If you think it is more probable than not that you are going to hold on to a bond until its maturity date and get that repayment at the end of the bond's life, therefore collecting interest the whole way, you should classify it as a held to maturity debt investment. And if you don't know, if you're in the middle where you're like, well, our intent is to hold on to this to maturity, but if we're going to be able to get the right amount of money, if someone wants to buy this bond off of us, we would sell it, and you don't know, well, you classify that as the catch-all, which is available for sale debt investments. So debt investments that you have in other entities are classified by when you think you're reasonably going to liquidate that debt and turn it into cash. For equity, the delineator, the thing that you would look at to see what you're going to classify it as, is how much of a company's stock you own. If you own less than 20% of the stock of another company, you have, as they say, no significant influence over that company. So it would be a no significant influence equity investment. If you own between 20 and 50% of another company's stock, you do have significant influence over that company. Why? Because each share of common stock is entitled to one vote. So if you own 25%, say, of another company, well, then when something comes up to a vote, your opinion alone counts for a quarter of all of the votes, and it's going to take a lot of other people to override your portion of the vote. If you own 45% of another company, well, then you only need 6% of the other investors to swing that vote in your favor. So you have a ton of significant influence over the company. That would be a significant influence equity investment. And if you control more than 50% of another company's stock, well, you own that company, because when something comes to a vote, no matter what anybody else thinks, you have more than half the votes, you're going to win the vote. You are a controlling interest equity investment. So for equity securities, buying the stock of another company, the way that you classify it is by how much of that other company's outstanding shares you own at the time.